Welcome. We follow this book, uh, first chapter Accounting in Action and Learning Objective 2. Including the Learning Objective 2, we have the ethics, gap, measurement principles, and assumptions. First one we discuss on ethics. Basically, effective financial reporting depends on sound ethical behavior. Unless we follow the sound ethical behavior, we couldn't prepare financial statements properly. And two, standards of conduct by which actions are judged as right or wrong, honest or dishonest, fair or not fair are ethics. Basically, United States, they have passed the Sarbanes-Oxley Act because of unethical financial reporting. To why? To reduce unethical corporate behavior and decrease the likelihood of future corporate scandals. Basically, the United States passed the Congress the Sarbanes-Oxley Act so that they can reduce the unethical financial reporting. Ethics in financial reporting, we discuss here the steps. The step number one, recognize the recognize an unethical situation. Number two, identify and analyze the principal elements. Number three, identify the alternatives. Here one question, ethics are the standards of conduct by which one's actions are judged as right or wrong, honest or dishonest, fair or not fair. All of these options. I think answer would be all of these options. Okay. Now generally accepted accounting principle. Generally accepted accounting principles. The accounting professions has developed standards. That standards are generally accepted and universally practiced. We call this is gap. And by the helping of gap, we can prepare the financial statements. And the financial statements are used by various users. You know the various users need financial informations, and users are two types, internal and external. The internally, the finance divisions, marketing divisions, human resource divisions, or management, they can use the financial informations. And externally, the investors, creditors, taxing authorities, regulatory agency, customers, labor unions, they can use the financial statements. Now gap standards that are generally accepted and universally practiced. These standards indicate how to report economic events, or we call it financial transactions. And we have found some standard setting bodies, and the first two from United States of America and this one UK, United Kingdom. This is FASB, Financial Accounting Standard Boards, and SEC, Security and Exchange Commission. This one IASB, International Accounting Standard Body. Basically, the FASB, this is the primary accounting standard setting bodies in United States, and SEC also the agency of the US government, and this SEC oversee the US financial markets and as well as accounting standard setting bodies. Okay, so here the SEC relies on the FASB to develop accounting standards which public companies must follow. The UK department or UK, the related department on the concerned department, the United States have adopted the accounting standards. We call this accounting standard is the IFRS, that means International Financial Reporting Standards. Now we discuss on measurement principles. GAAP generally uses one of two measurement principles. Number one, historical cost principles dictates that companies record assets at their cost. Number second, fair value principles states that assets and liabilities should be reported at fair value. That means the price received to sell an asset or settle a liability, we must follow the fair value when we sell any asset or settle down any liabilities. Historical cost principles, here we have an example, very simple example. Suppose this Best Buy company purchases land for 3 lakh taka. Suppose next year the fair value of the land increased 4 lakh taka. So under the historical cost principle, it continues to report the land at 3 lakh, not 4 lakh. Okay. Now fair value principles. The fair value principle, that will present value when we transactions or when we collect any asset or settle down any liability, that times just we follow this fair value, because market price information is usually readily available for these types of assets. Now assumptions. Assumption provides a foundation of the accounting process. Monetary unit assumptions, that means the record only transactions data that can be expressed in terms of money, in terms of amount, in terms of dollars, suppose. And economic entity assumptions, that this is suppose the owner and this is the organizations. The owner and the organizations, that means entity be kept separate or distinct from the activities of its owner and other economic entities. On the basis of ownership, just we have formed the business ownership in three types: proprietorship, partnership and corporation. Now we discuss them. Forms of business ownership. Proprietorship, this is one person's, he owns the business. That means here one person, owned by one person. Number second, owner is often manager or he is the operator. Or owner receives any profits or suffers any losses and is personally liable for all debts. And partnership, partnership consists of two or more persons. Two or more persons consists the partnership business. The owned by two or more persons. Number second, often retail and service type business may be generally unlimited personal liability or partnership agreement must be needed to operate the partnership business. Corporation. The characteristic of corporation, we discuss on ownership divided into shares of stocks. Number second, separate legal entity organized under estate corporation law and limited liability. So now we have some question related to assumptions. Combining the activities of two companies, Kellogg and General Mills, would violate the, which one would violate cost principle? No, this must not be violate. Economic entity assumption, it may be. Monetary unity assumption not violate, and ethics principle not violate. So I think the B will be the answer. Yes, B. Now question number 2, that means the business organization as a separate legal entity under state law having ownership divided into shares. We know the divided into shares related to corporation. So I think answer would be the corporation. Yes, thanks. Now we have some true and false here. True and false. Number 1, Congress passed the Sarbanes Act. Yes, this is true. Number 2, primary accounting standard setting body in America or United States, the FASB. Yes, I think this would be true. Yes. Historical cost principles dictates the company's record asset at their cost. Yes, but later period, however, the fair value. No, this is, I think this is false. Number 4, relevance means. Relevant means that financial information matches. I think not relevant means it would be faithful representations, not relevance. This is false. Yes, false. A business owner personal expenses must be separate from expenses of the business to comply with accounting economic entity assumption. Yes, this must be true. Yes, true. False and true false. Thus, this is the explanations. Next lecture I will discuss on the steps of accounting equation, define its components. That means asset, liabilities, and owner's equity. End. Thanks.